So, what is inflation? Well, in its simplest form, it's when there's too many dollars chasing too little supply, and that causes prices to go up. Your dollar just won't go as far as it did yesterday. Now, this last year has been a year of really high inflation, and that's a foreign experience to so many of us because, well, we've never lived through inflation. It's been over 40 years. This means any home buyer between 20 or 60 years old has never bought real estate during a time of inflation. Now, in our last video, we talked about how the Fed rate does not directly affect mortgage rates. And since that message, the Fed's raised rates 0.25% and mortgage rates actually improved slightly. Remember, it's the bond market that affects mortgage rates. And the reason mortgage rates or really any long term bond is going to be driven upwards by inflation is because it erodes the buying power to the recipient of that fixed payment. Think about it. As a bond investor, my price to invest is going up while my low rate of return, it's kind of frozen in time. Inflation truly is the arch enemy of mortgage rates. Now, to understand when mortgage rates should come down, we really need to understand when is inflation going to come down. So today, we're going to understand how mortgage rates take their lead from inflation. You'll learn the primary reason that inflation is still running high. And then we'll look at when that should cool down along with mortgage rates. There's going to be a lot of great stuff here. Can't wait to get into it. Let's have some fun. Now, this chart represents 42 years of mortgage rates. And if you look back here in 1981, rates hit 18%. Again, this was a result of inflation. Boy, this chart really puts things into perspective. I mean, I think we've all been a little spoiled with where rates have been, not just for the last couple years, but really for the last 10 years or so. While rates may seem a little high now, we're actually about 1% under the average rate since 1971 of 7.75%. Now, let's look at a more modern chart to help illustrate how mortgage rates take their lead from inflation. So this chart represents 5 years of mortgage rates and inflation from 2018 through 2022. The bottom line in pink right here, that's inflation. This baby blue line, that's mortgage rates. You can see historically, inflation rises, mortgage rates rise. Soften, mortgage rates soften, inflation goes flat, and mortgage rates go flat to right around March of 2020. Recall, of course, this is when COVID hit. What I really want to focus on here, where this white bracket starts, is something called quantitative easing. Quantitative easing, or QE, it's a monetary policy whereby the central bank purchases predetermined amounts of government bonds or other financial assets in order to maintain stability and liquidity in a troubled economy. So they invested in mortgage-backed securities, the Feds did, by the billions. And as you see on this graph, it kept mortgage rates right around 3%. Now, right here, inflation starts to rise from very low levels near 1%, and the Fed thought it was transitory. And the reason mortgage rates did not respond like they normally do, it's because the Fed continued buying enough bonds to tie them right to that 3% rate. Now, once they understood inflation was not transitory, they stopped buying mortgage bonds, and rates started to move higher. But now, they were so behind, they really had to sprint to catch up. But eventually, mortgage rates did what they always do. They follow inflation. So as inflation rose, mortgage rates rose, inflation took a reprieve, so did mortgage rates. We actually saw inflation come down at the end of 2022. Mortgage rates made some meaningful improvement. Now, inflation is indeed on its way down. Here's a graph on the year-over-year change in the Consumer Price Index, or the CPI, and we actually just got fresh readings last week that show we are still in decline year over year, reading at 5.5%. Now, we don't think it's going to be a straight line to lower inflation and lower rates. I mean, there's certainly some potential headwinds. We absolutely do have expectations that inflation, it'll show a more meaningful decline throughout 2023. And here's why. First off, when the Fed increases the funds rate, that impact to the economy, it's not immediate, and the deeper inflation is, the longer it can take for those measures to really take root. So all those significant rate hikes that you saw last year, they're still being digested by the economy, and they'll continue to be. Inflation works in that it's actually measured on a 12-month average. So when inflation rates were released in March this year, that replaced March reading of 2022 in the 12-month average. But inflation was particularly hot during last spring and summer months. So as we have better inflation numbers to start replacing these spring and summer months, that really should bring down inflation. And really, we've already seen prices start to come down across the board for food, gas, clothing, etc. But shelter cost, those are what's really still showing an increase in inflation, but that's due to something we call the lag effect. And this is really important to understand. The Consumer Price Index, or CPI, it's the most widely used measure of inflation because it averages prices paid over time by consumers. Shelter costs are a very big part of inflation. Currently, they weigh in at 43% of CPI. Now, we are seeing shelter costs come down rather significantly. We look at this pink line here. This represents real-time data on apartment listings, and you can see how they skyrocketed from pandemic lows in 2020 all the way up to 18% year over year increase in January 2022. If you look now, we're actually closer to 3% year over year increase, and it's still going up at these levels, but with a lot less inflationary pressure. But the way that it's calculated in the CPI numbers, again, it averages the past year, which you can see tracked by this blue line, which currently shows an 8.1% increase. And the result of this is upside pressure to inflation because it's not really taking into consideration the live, real-time data of 3%. The reason for this lag is that leases, they don't all turn over at once, right? It takes time for those new leases to reflect what's happening. So you're kind of locked into paying those high payments for a period of a year or even more. And this has a big lag effect, and it adds buoyancy to the current level of CPI. But when this catches up, it will, you can assume that CPI will drop significantly. In fact, to get a more accurate figure, you can just take the difference of these two numbers. It's 5.1%, and do a mathematic equation. Just multiply it by the weighting of shelter at 43% of CPI, and on a real-time read, we'd be at 3.3% versus 5.5% on the core CPI. And the result should be clearly lower mortgage rates. As we move forward and leases turn over and we replace the 2022 summer months of scorching inflation, these numbers should eventually roll over and get back in step with each other, just like it was back here. Really expect this to happen as soon as May, once housing data starts to catch up. Okay, so when the Feds made a decision yesterday to raise rates another 0.25%, it was on the heels of exactly what we just talked about. Chairman Jerome Powell noted that the primary reason inflation was still running high was housing. In fact, the exact quote, "Housing services is really a matter of time passing. We continue to see new leases being signed at much lower levels of inflation," and that's 44% of PCE. Now, let me give Mr. Powell some credit here. He did acknowledge everything I just showed you. And I'm not here to call somebody out for an honest mistake, but let me just point out, housing makes up 43% of CPI, as I showed you, not personal consumption expenditure or PCE. Housing's only about 20% of that. Now, I'm trying hard to believe and support our government, but this is the same person who thought inflation was transitory. And when our own chairman doesn't get a measure of inflation correct, I mean, he's supposed to be able to operate under pressure. And regarding another rate hike, while banks may be collapsing due to too many rate hikes already, what are we really trying to accomplish here? Are we trying to break the banking system? Because look, that's what we may be doing. And think about it. You have somebody who's very sick. You don't just give somebody a pill and expect them to be better the next day. And when they're not, you don't just keep feeding them more and more of that same medicine over and over again, especially if that very medicine requires time to be effective. That's how you overdose a patient. The monetary policy of raising the Fed funds rate, it requires time to achieve results. And We're getting results, but at what cost? Every action has a ripple effect, not just for Americans, for a global economy. We're all connected. So could it be that we've gone too far and that we're headed for another recession? Yes, it could mean that. What does that mean? A recession to you or to mortgage rates or to real estate? Is it going to be like last time? Well, in the next video, we're going to dive into why it looks like we could be in or headed to another recession and why we don't think it's going to look anything like the last one. You don't want to miss that. So if you haven't already, make sure that you subscribe to my channel. And if you found this helpful, please share it with somebody else you care about because they may as well. We all deserve the truth. Thank you for your time. I hope that made a difference.